and welcome to the home buying process, what you need to know about mortgages, PCCU Flex class. I am Amy Clark, mortgage loan officer for PCCU. I have worked there a little over 28 years and have been doing mortgages solely for a little over 6 years. My apologies, this is my first presentation, and I'm going to do my best to not sound like a robot. I probably will be looking at my notes quite a bit, so to not miss anything. We can take questions at the end. If you would, please hold them till then or type them out, and we'll address them at the end. Sometimes I think the mortgage process sounds like a four-letter word to people based on reactions. It is not. I'm not saying there isn't work involved on both of our parts, but when you reach your goal of home ownership, you will look back at it as one of the most fun and exciting times of your life, I hope. When asked to do the class, I thought about it for a while, and then I narrowed it down to the following phases. You would change the slide, please. So there, in my opinion, there are 6 distinct phases of the mortgage loan process: the pre-approval, the house shopping, the mortgage application, loan processing, underwriting. Those kind of go hand in hand, and then the closing. You change it again, Kim. So the first phase in the process is the pre-approval, or pre-qualification, if you will. A couple of things about this. The application can be intimidating. It is about 10 pages long on average now, but it mainly involves answering questions about your employment history, income, assets, and the home you want to buy. It also involves a credit check. It is important to note here that once you are pre-approved, you should not open any new accounts or make any major changes in your credit card balances, as it could affect your DTI. Also, once approved, you will receive a letter that you can give to a realtor and or the seller. Most realtors today won't show you a house without one. So the first step in the pre-approval, getting pre-approved, is calculating how much house you can afford. Typically, when I meet with people for pre-qualification, they want me to tell them how much they can afford, when ultimately they know better than anyone how much their budget will allow. Often I can get an approval for much higher than you may want to or need to spend. We, as a lender, they don't include monthly bills such as utilities and groceries, cell phone, childcare, just to name a few, when calculating your debt to income for an approval. And we all know any one of those or all of those could be higher than a house payment. So a lender looks at 2 ratios, the housing and the DTI that I mentioned, for qualification purposes. I've been doing this for a while, so I don't want to assume that everyone knows or understands ratios. So it's just this. A housing ratio is your mortgage payment divided by your gross monthly income. Monthly, yeah. The debt to income is all your monthly debt divided by your gross monthly as well. When looking at the products that we offer, a housing ratio should not exceed about 31% on the high side, and then the total debt ratio can go up to 50%. So you see why it would be important to think about all the debts that aren't on the credit report when trying to decide how much house you can afford. Just as an example, I had ran numbers. If you made $5,000 a month and you had a house payment of $840, that's a 17% housing ratio. That's acceptable for sure. And then if you had, for instance, $1,200 in debt, including the house payment, with a $5,000 a month income, your DTI would be 24%, so also more than acceptable. And in case you didn't realize, your mortgage payment isn't just principal and interest. It may or will include escrow. That's unless you're putting 20% down, and possibly PMI. And we'll talk about that in a minute. First, escrow. It's a term you've probably heard, but not maybe familiar with what it is exactly. It is property taxes and homeowners insurance paid monthly in monthly installments to the escrow account. It could be under $100 a month for both of those things, depending on how much house you're buying, or several hundreds of dollars. One thing I would recommend is getting pre-qualified, pre-approved for the maximum amount. It's easier to be approved at that higher amount and find a house that costs less than vice versa. When preparing to get pre-approved, you also need to think about saving for a down payment and closing costs. A down payment is a one-time large payment towards the purchase of a home. Down payments can be as little as 3 to 5% on a conventional loan, depending if you're a first-time buyer or not. While FHA requires 3.5% down, and USDA and VA have no down payment requirements. I do want to mention that anything less than 20% down, though, on a conventional loan will require PMI. What is PMI? PMI is insurance that basically protects the lender if the borrower defaults on the loan. It does not protect the buyer in any way, but it is your responsibility to pay that premium. So other obvious benefits to a larger down payment, aside from eliminating the PMI requirement, would be a lower monthly payment and a lower interest rate. Closing costs would be the fees you pay to get your mortgage loan. Fees included, but not limited to, lender fees and title fees, recording fees, appraisal, appreciation for your loan officer fees, completely kidding on that one. But you will also have other expenses that are called prepaids and reserves. Prepaids and reserves are the monies needed to establish your escrow account. So that would be like your first full year of homeowners insurance, and typically a 3 to 6 month cushion, depending on the time of year that you're closing and when you would assume the property taxes for the property. Obviously, there are several factors that go into this, but I would plan on a minimum of $3,000 for both of those. Without getting too deep into it, I wanted to note that if you are lacking funds to cover your closing costs and down payment requirements, they can sometimes be withdrawn or borrowed from an eligible 401k plan or pension plan. And then there are gifts, which may be an option depending on the type of loan that you choose. And there's also some seller credits. A gift is just that. There's no expectation of repayment. It does have to come from a family member or a close friend, the buyer's employer, or a government agency. Seller credits are kind of similar to a gift. A seller can pay anywhere from 3 to 6% of the purchase price towards the buyer's closing costs and prepaid items, if they're willing to, and depending, again, on the type of loan you choose. While the first two items, the saving for down payment closing costs and calculating how much house you can afford, are probably more concerning to you, the buyer, the next thing I thought about in the pre-approval process relates more to me, the lender, and that is the 4 C's of credit. The first C is capacity. That's basically your ability to repay the loan. Capital, I would think of it as like this: the more of the buyer's funds, money, in the transaction would equal a stronger application. And the more money the buyer has left at the end, at closing, there's less risk of default. Collateral is obviously the house itself. and then credit. Minimum credit score of 600 for a VA loan, and then 620 for all other loan products. I did want to note here that it has been my experience that Credit Karma is typically off in either direction, too high or too low, as much as 50 points, but it still may give you a good indication of where your scores are generally. When doing a mortgage application, we actually pull a tri-merged report using the median score for qualification and any rate adjustments. I did want to mention, in case anyone might be wondering, there is a 4-year wait after a Chapter 7 bankruptcy, and a Chapter 13 has a 2-year wait after the date of discharge, or a 4-year wait if there's a dismissal date. The last thing I wanted to mention in regards to credit is something called non-traditional or alternative credit. If you only have 1 or 2 scores instead of 3, you may still be able to purchase a home using this type of credit. Some examples would be things such as rent, auto insurance, gym membership, cell phone, utilities, debts that you would typically pay monthly out of your account that would indicate your capacity to repay mortgage loans. The final step in the pre-approval process is figuring out what loan is best for you. The obvious things you would have to consider are what down payment you can afford and what your credit scores are. FHA might be the best if needing lighter credit restrictions and less restrictions in regards to the down payment. USDA has no down payment requirements, but the property has to be in an eligible area, and household income has to meet their requirements. VA also does not have any down payment requirements, but you have to have served or be serving in the United States Armed Forces or be a widowed spouse of a veteran to qualify. Another huge benefit to the VA loan is no PMI ever. I did want to mention here, because not all lenders do, but we do finance manufactured homes. They have to be built after June 15th of 1976, be on a permanent foundation, and converted to real estate prior to closing. And finally, you will have the option of a 10, 15, 20, or 30-year term on your loan. Government loans are typically 15 or 30 years, but we would work together to find the loan that best fits your budget. So now you have figured out what type of loan you need, and you have your pre-approval. The next phase in the mortgage process is hopefully the fun part, shopping for a home. You can change this one. Who better to help you with that process than a real estate agent? Finding the right real estate agent, in my experience, typically comes from a referral from a family member or friend, or me, your lender. And if you don't already know, real estate agent fees are paid by the seller, not you. If you don't buy a home, you owe them nothing. Before signing any contracts, make sure you feel comfortable with them and have a sense of trust. They will act as the middleman in the negotiation process when you get there. If possible, in my opinion, don't share a realtor that the seller has that the seller is using. Who are they really working for? A real estate agent must be licensed and is held to a strict code of ethics. And they also have access to comparable sales, local history, and neighborhood demographics, all which are probably very important to you, the buyer. They should also help set realistic expectations in regards to the price point and what the timeline looks like in the home buying process. So you've decided on an agent, and now the house hunting begins. Real estate agents will be helping you through the process of making an offer and inspection. Your agent will know if the home meets your pre-approval loan amount, if it would pass FHA inspections, or is in a USDA qualifying area. They've got tons of knowledge. Real estate agents have access to all the homes for sale in the area you are looking in as well. Now you've found a home. Let's talk about getting an accepted offer. That offer is in writing and contains information about you and the property you're wanting to buy, the price you're willing to pay, any seller credits towards your closing costs, and a deadline for the seller to respond. Some offers may also include an earnest money deposit. Typically, it's a small amount, somewhere between $500 and $2,000, depending on the price of the home. This deposit goes towards your down payment or closing costs if you buy the home. Don't be misled, though. If you agree on terms and later cancel, you could lose that earnest money deposit. I, as a lender, would also need a copy of the signed and accepted purchase agreement, as well as the earnest money check, if applicable. So you've got an accepted offer. Now what? We're going to tie that property address to your pre-approval and get your mortgage application started. You would change that slide, please. Here we go. So the mortgage application also includes, I guess, some important documents that you may need. I have a short list. It's not limited to this, but you can plan on needing 30 days of pay stubs. So if you are throwing those away, please stop. Last 2 years tax returns with W-2s, last 60 days of bank statements for assets, checking, savings, or last quarterly statement if you're using a 401k or retirement. You might need divorce agreement, child support docs, bankruptcy papers if those apply. Any document that would verify information that was entered on your pre-approval. Verification of income and assets may include a need for a full written verification of employment from your employer, especially if you're using bonus or commission money to qualify, or if your hours that you work are inconsistent. It's been my experience, if you can qualify without using a bonus or commission, then that's the way to go. It's typically a lot less paperwork, a lot less headache. Your savings and checking accounts are going to be evaluated by the underwriter. Be ready to document and prove where any large deposits came from in the past 60 days. This is where verification of rent may also be needed from a landlord and copies of canceled rent checks for the last 12 months. And then finally, their gift funds. The gift letter would need to be executed documenting the source of the funds and then possibly the transfer of funds to the borrower's account. This is where you would receive your initial disclosures that contains a loan estimate outlining all the financing details for you. It is important for you to review these docs, make sure it's correct, and it will be a good indication for you of what your financial responsibility will be at closing. It is also time to be thinking about locking your interest rates depending on the market. Ultimately, we will work together to make sure we have all the docs needed for loan processing. The clock is ticking now. My ultimate goal is to get you to the closing table as quickly as possible. Change the slide, please. The next step would be loan processing. Actual processing does not start until all the documents are gathered from the buyer and submitted. Part of the processing process would be the home appraisal. I'm sure you've all heard that term before, but it's basically a review of the property that gives everyone involved in the transaction a current value of the property. It is ordered by the lender, not the buyer or seller, ordered through nowadays an appraisal management company and prepared for the lender. It's just a way of making sure that there's no lender or buyer influence on the appraiser. This is also when you might want to get a home inspection. An inspector goes through the home specifically looking for issues. They will test electrical systems, make sure your roof has at least a 2-year life left on it, make sure appliances are working, and much more. Conventional loans do not require any inspections for your loan, but if you're doing a government loan, it may require water inspection if the home has a well, a termite inspection if you're doing a VA loan, or any other inspections that the appraiser deems necessary or that should be done. And then finally, the title commitment. The seller typically decides what title company will be used for closing. The title company does a search against all parties connected with the transaction and reports back to me, lender, any liens, defects, obligations, etc., that affect the subject property. It also lists any requirements or exceptions, any exceptions or exclusions as well. Typically, medical collections do not have to be paid prior to closing on a home, but if you have any liens or judgments, those might most likely would have to be paid. Another part of the mortgage process is underwriting. An underwriter, basically, I'm sure you've heard that term as well, is a financial expert, I looked it up, who evaluates your income, debts, assets, and property details and has to give the final approval on your loan. Your application would initially be approved with conditions after the underwriter has done his or her initial assessment. That means you are good to proceed, assuming you can produce whatever documentation they're asking for. You can expect that additional documentation will be needed, though. It's sometimes 2 or 3 rounds of conditions, depending on the situation. It's all about making the underwriter happy. Not really. It's about following Fannie Mae guidelines and rules. It could be they need more income verification. And like I said before, the rental verification, divorce agreements, child support docs, or bankruptcy discharge papers. During this time is between the processing and underwriting, you would also be working to get a written quote for homeowners insurance if you haven't done so already. Other docs that I did think might be needed, something to think about would be credit card statements, potentially proof of payment on a liability, something like that. It could even be docs needed from the seller as well, such as death certificates or POA. Okay, we're almost done. You have your final approval. Now what? The final step in the mortgage process, one of the most important parts to you probably. The first part of closing involves getting a clear to close. A clear to close is issued once all the conditions set by the underwriter have been met and they have given their final approval. After the clear to close is issued, there is a document called an early CD, an early closing disclosure, that will be issued and needs to be signed by all buyers. The early CD is a mortgage document that basically outlines all the details of your financing. It will give you a breakdown of your loan amount, your monthly payment, interest rate, and all fees required for you to obtain this loan. Any seller credits, realtor fees, etc. Sound important? Familiar? It's so important that the lender has to give you 3 business days to review the CD before your actual closing can be scheduled. This allows the buyer to review the docs and compare it to the loan estimate they were given at application for any errors or mistakes. In the meantime, once we have the clear to close, your real estate agent will be working with you and the seller, the lender, and the title company to get a closing date set. The closing will take place at the title company. And finally, we're there. It is very important for all people involved, all parties, to have their ID with them at closing, or closing won't happen. The buyer would also need to bring a cashier's check for their funds that are due, or wire the funds directly to the title company prior to closing. There will be several documents that need signed, but probably 2, that you would care the most about: the mortgage and the deed, which officially makes you a homeowner and hopefully a satisfied customer member. So I just kind of skimmed the surface of the mortgage loan process, and I hope it wasn't too overwhelming. Last slide, just ask for questions, and I have included my contact information, my email, my cell phone. You can call or text, and then my office number. I am working from home, but I still receive those calls as well. Please feel free to contact me if you do have any questions after this is over. And then I also included the link for the USDA eligibility map and income guidelines. That is it.
Amy, I have a question about how long on a purchase does it take to go from maybe the phase of shopping for a house to closing, not the pre-approval, but just you've been pre-approved, now we're shopping, find a house to close?
It's hard to say on the shopping part because even still today, it sounds like a lot of houses are selling before, you know, as quick as they're being put on the market. So it has been my experience this last year, especially, that I have people get pre-approved and may not actually get an accepted offer for 3 months or maybe longer.
How long does that accepted offer last? Oh, sorry.
No, you're fine. The pre-approval, it is good for 4 months. At that point, we do have to do a new credit check, but then the application is good for another 4 months. So you could do 8 months. After that, it does require a new application. I started to say the process from the time I gather all the documents from the borrower and actually submit it for processing. We shoot for 30 days, but you know, in all honesty, it's been taking closer to 45. The other issue, initially when COVID started, the title companies were bombarded, and it was taking a lot longer to get title commitments from them, and then to get the closing scheduled too. But now, at least this year, it's not title companies, more appraisers. We are running into issues. From my understanding, we've had a lot of appraisers retire and not too many people coming into the business. So our pool is kind of dwindling, and they have been overloaded as well. So it is taking sometimes 3 weeks to get an appraisal back for them to get out there, do it, and then submit the report. So those are the holdups typically. It's not because, you know, the underwriters being ridiculous, asking for things that you can't produce. It really is more of a waiting game through most of that process, in all honesty.
Good. And did I hear you correctly? You mentioned something about medical collections, not, did you say that they aren't considered or aren't required to be paid off?
Typically, a collection is not. Now,
Okay.
judgment and lien would be.
Okay.
Medical sometimes can be treated differently than if it's a utility or something like that you didn't pay and they ended up filing against you. So I can't say for sure that all medical judgments have to be paid either, but I feel pretty confident that they would. If it's a judgment, it will.
Yeah. And it's just hard anyway to have a credit score maybe that qualifies without getting some of that stuff taken care of anyway. But I just wanted to make sure I heard you correctly.
Yeah, right. And the credit scores have been kind of varying somewhat in the last year and a half as well. They really tightened down on, you know, eligibility, and there for a little while, if you didn't have a credit score of 680, or higher, you probably weren't getting approved. And so that has come back down. I was, like I said, the VA is 600 and it's 620 otherwise. So it just made it hard for some people to qualify based on that, because there's just no gray area. You have to have a cutoff somewhere. That's where it is. And so you just try to work with them to see what they need to do to improve their credit if that's what the issue is.
Very good.
All right. Well, thank you very much. I appreciate the opportunity to do this, even though it was kind of nerve-wracking at